and welcome to the WARR HUNT Quarterly Investment Update for the 30th of September 2020. My name is Sam Hunt and I'm a Director of WARR Hunt's Melbourne office. And today I'll be joined with Dr. Steve Garth, who is an independent member of the WARR HUNT Investment Committee. Well, Steve, we had promised to kind of catch up in person this quarter, but that clearly hasn't happened. And it's been a pretty interesting 12 months. And I was wondering if you could just sort of touch on, Steve, as to what have been the themes for the quarter and what we've seen over the last 12 months, both in Australia and internationally.
Yeah, thanks, Sam. Welcome to you and welcome to everyone watching. Let me just start by saying the quarter started off really well. Financial markets took off in the first bit of the quarter, and we'll see that overall positive results in nearly all the asset classes. There were some wobbles in September, which people might remember, where we saw a little bit of a correction, particularly in the big tech stocks. They came back about 8% in September. But overall, those tech stocks, and we'll look at those in a little bit more detail, have had an incredible run over the quarter and over the year. Sam, I'll just put up a slide now showing people how the different asset classes went. First of all, looking at bonds at the top row there, and we can see while cash in Australia is zero, bonds had a positive return over the quarter, about 0.6% for Australian bonds and 0.7% for global bonds. When we look at equities, you will see Australia there just a little bit negative. It's really been flat for the quarter, but it's positive returns from both the developed markets and the emerging markets. When I moved to looking at the 12 months, good returns there from Australian bonds and global bonds of the order of 3 and 3.5%. That might surprise people because I think everyone's aware that bond yields are very low, but you can still see positive returns coming from bonds, even though the yields themselves are very low. When we look at the equity markets in the second row there, big red arrow going down for Australia. Australia's down by about 10% for the 12-month period. But as we move across, you can see that both the developed markets and the emerging markets are up for the full year period. And global REITs, again, they're the worst performing asset class over the entire year. They're down about 23-25% over the whole year.
Thanks, Steve. Can you tell us a little bit more about sort of the domestic market, the Australian market and the international market from a 12-month perspective? I mean, as you mentioned, it's been a pretty wild ride. We're sort of all-time highs in February, all-time lows in March. Where are we at overall over the 12 months?
Yeah, Sam, the chart I've got here shows the Australian market over the last 12 months. You can see that big dip starting at the end of February, but then rising again throughout March. Nonetheless, as I mentioned, you can see the Australian market down about 10% for the whole year. You can also see that in the last quarter, it's flat. Sam, if I now overlay the performance of the US market, of course, that's the most dominant market in international markets. It's about 55% of all the developed markets by market cap. And you can see that the US market, while it's got that same fall in February and the rise in March, it's also done a little bit better over the 12-month period. It's in fact up about 4 or 5% from where it was at the start 12 months ago. But what's really been driving that, Sam, is a group of stocks called the FANGs, which the audience may have heard about. It's an acronym for Facebook, Apple, Amazon, Netflix and Google. And the chart I'm putting up now shows you the performance of that group of stocks. Microsoft is in there too. And you see this incredibly strong performance. They're up something like 35% over the quarter and over 100% over the year. You can see that little wobble I mentioned in September, but it really didn't stop their progress that much. Now, that really is the difference between the return of the US market and the Australian market. It's that group of stocks. They're about 25% of the US market, and they're really driving the positive returns we're seeing from the US and from international markets compared to Australia.
It's a really interesting parallel between, say, the Australian market and the US market, where the Australian market is heavily dominated by resources and bank stocks. But then, you flip that over to the US, which is now heavily dominated by tech stocks or those new economy stocks. So it just really does speak to the importance of diversification and how different markets can play out at different times.
It's such a good point, Sam. The Australian market, as you say, is dominated by banks and finance. And when we talked about the Australian market down by 10% for the year, as measured by the ASX 300, that's really got to do mainly with the poor performance of the banks. And as we've just seen, the good performance of the US has mainly got to do with those high tech stocks. It really does speak to the power of diversification. Australia's quite a concentrated market. It's got those two dominant sectors. But when you look at markets in the US and even in Euro, the tech sector and the pharmaceutical sectors are very large over there. And of course, that's also another driver of positive returns. And they've got obviously a much larger manufacturing sector than Australia. So you really do get a lot of benefits from diversification across Australia and global markets.
Maybe I'll just get you to expand, Steve, on what's happening in the economy. We're seeing a lot of doom and gloom. We talk about recession, huge budget deficits to try and stimulate the economy. Is there any relationship between what's happening in the economy and what we're seeing in markets, both domestically and internationally?
You are absolutely right. The economy obviously is not in great shape. The good news is it is actually been improving since the February-March period. Melbourne, of course, is a little bit of an outlier there. You guys have, had to put up with some pretty tough lockdowns. But we do expect the economy to improve, but it will be slow and it will be bumpy. I think underlying inflation will certainly remain very, very low. Government stimulus will remain large. Interest rates will remain low. The RBA met last week and didn't change the cash rate from 0.25%, but most economists are expecting the cash rate to be cut again before the end of the year, right down to 0.1%, and for there not to be a rise in that interest rate for quite some time. So all that sounds gloomy. I think some positive news is that Australian assets are probably likely to benefit because of the really good virus control. And besides a little bit tit for tat with China, our exposure to China will also benefit our assets. Obviously, there are uncertainties that are out there. The biggest uncertainty, of course, is second waves or third waves of the coronavirus. We don't know when or if there will be a vaccine. And so certainly risks around the economy could be further shutdowns, further unemployment, bankruptcies. In the news a lot is the US election. People say that's a great deal of uncertainty. I would argue that that's really just short-term uncertainty. The media loves US elections, but the markets in general look through that. There won't be big changes regardless of who wins the US election. Sam, I'll just finish with this slide here, and it's really worth reminding the audience. I've just gone through a little bit of doom and gloom on the economy, but keep in mind that the economy and the stock market are two different things. The economy is looking at the data right now, where the stock market is pricing in expectations for the future 10, 15 years down the track. And markets do an excellent job of pricing in everything that investors think. So all the good news and bad news is priced in right now. And it's really important to realize that it's not what we expect to happen that changes markets, it's the unexpected that changes market price. So stay disciplined, stay diversified, stay the course, and you will get the reward that comes from the financial markets.
Thanks, Steve. I think that's a really good way to sort of conclude the presentation. So thank you all for attending this presentation. And of course, if you have any questions or concerns, please don't hesitate to contact your advisor at WARR HUNT. And until the next update, please stay safe, stay sanitized, and we will speak to you again soon. Thank you.
Goodbye.